Compliments of the season to everyone. Thank you all very much for taking the time to join our quarterly investor call. Just a bit of housekeeping before we start. Please can everyone mute their phones to stop all the background noise. And may I ask if you have any questions, you save them to the end. We'll leave 10 minutes at the end for questions. On the call we have our three portfolio managers, Craig Banderson, Rainer Ort and Tony Shrien, as well as myself, Harry Wolfson. I'll hand over to Craig shortly, who will focus the call on our flagship Pan-African fund, the Imara African Opportunities Fund, which is our high conviction, bottom-up, best ideas portfolio. Just to say, 2017 was a strong year for all our portfolios, which were all up over about 20%. We really see 2017 as a year of economic and political reform in many of our main markets. But looking forward into 2018 and 2019, we're optimistic that these reforms will take hold and will move into a period of more accelerated growth. Now I'll hand over to Craig to discuss the performance of the portfolio over the last 12 months and the outlook for the coming year. Thanks so much, Craig.
Thank you, Harry. Good evening, everyone. Just to start off with, perhaps let me give a quick overview of the fourth quarter. The S&P Africa was up 3.4%, the MSCI Africa was up 2.6%, and our fund was up 20.2%. That's the Imara Africa Opportunities Fund. For the year, the fund was up 21.7%, the MSCI Africa was up 22.3%, MSCI World was up 20.1%, MSCI Emerging Markets was up 34.4%. So it was certainly a strong year. I think, what we saw was an acceleration of economic growth across the continent, pro-business economic reform. We saw various countries move towards liberalized foreign currency regimes, and particularly in Zimbabwe, we saw political regime change. We sent out a note in November giving detail on what our view is for that country, and I'll chat a little bit more about Zimbabwe later. I think one issue we need to highlight was our use of the old mutual implied rate. A lot of investors have been asking about that. The rate is based on the price ratio of Old Mutual Zimbabwe shares and Old Mutual South Africa shares. When we took the decision to recommend a move to the Old Mutual implied rate, we were thinking that the Old Mutual implied rate would mean revert over the long term. We were sure our investors were committed for the long term. At that point in time, the discount was 36% to the US dollar. But what happened in September and October certainly surprised us and the rest of our peers, in that the Old Mutual implied rate moved very sharply upwards, ending October with an implied discount of 82%, which had a very, very significant negative impact on the portfolio. Whilst this was surprising to us, we were sure that the Old Mutual implied rate would mean revert, and at the time of speaking now, it's at about 1.46 to 1.46 Zimbabwean dollars to the US dollar. For us, we're comfortable with using this mechanism until we see a very clear commitment to a more balanced monetary policy and a re-engagement of the international community, and see the country adopting either a very official peg, which is backed by some US dollars or another hard currency, and then at that point we'll switch to using whatever that local currency will be at that point in time. I am going to start off with perhaps our biggest market, Zimbabwe. And I think the main thing to highlight there is that we've seen a very, very positive shift in terms of political will to re-engage the international community. Mnangagwa has certainly been putting in significant air miles into flying to different countries and talking to multilateral institutions and international countries, trying to build goodwill for Zimbabwe. But what we're trying to see is three things. We want to see free, credible elections. We want to see a respect of property rights. We also want to see just a very consistent message across the entire government in terms of re-engagement of the international community and bringing in international funds. I think what you saw before and what was hampering development was factionalism within ZANU-PF. That's now fallen away. ZANU-PF is realigned. MDC seems in disarray, so it's very likely that the elections in July and August will be free and fair and without violence. In terms of opportunities, within Zimbabwe, we've done an EV per real asset valuation. The big opportunities we're seeing are Delta Breweries and Econet. We did a small note on Delta within our investment note in November. The EV per hectoliter right now is at about $170 per hectoliter. African regional comparators are at about $250 per hectoliter. So it's still trading at a discount to regional peers and international peers. It costs about $150 per hectoliter to build a new plant. We've done the same for Econet, where it costs about $200,000 per base station. International peers are trading at about $1.1 million per base station. Regional peers at about $500,000 per base station. So on these real metrics, Zimbabwe is still cheap. The allocation is larger than perhaps we're comfortable with at 43%, but we're rebalancing the portfolio tactically, rotating out of equities at good prices and buying Old Mutual opportunistically. I think the thing that we're very careful of is having a negative price impact on shares by selling too aggressively. And obviously, we don't want to push up the Old Mutual implied rate as well in the process. We're very comfortable with the companies. We've done our real asset valuation. We've done our DCFs, and we've done fair value multiples using the Old Mutual implied rate. And we're very comfortable with the portfolio. We feel it's trading at a discount to regional and international peers. And they're very good companies, bottom up, with low risk of permanent capital loss. I mean, bear in mind, these companies have survived a recession, deflation, a depression, hyperinflation. So these are very, very robust, anti-fragile companies. Moving on, I'll touch.
Oscar Lewis, and I'm now joining the call from London. I just wanted you to know I'm on the line. Thank you.
Hi, Oscar.
Hello.
Thank you. Moving on now to Nigeria. Nigeria is very exciting for us. I think we're seeing a move out of the negative sentiment, kind of large fiscal deficit, high interest rate environment that you're seeing in 2015, 2016. I think the really important thing for us, and we included this in our market report, is the Naira price per barrel of oil. So on current prices, you're seeing that the Naira price per barrel of oil is significantly higher than what it's averaged. It averaged closer to 13,000, 14,000. And what you saw in 2015, 2016 was a build-up in arrears in terms of civil servant salaries and in terms of pension contributions. And you saw domestic borrowing being crowded out by the government's issuance of T-bills because of the fiscal deficit. This is now reversing. You've seen domestic yields drop. You've seen them swing to a budget surplus. The Naira per barrel has a sufficient buffer at $70 per barrel now, over and above what it used to be. You've also started seeing civil servant salary arrears being cleared, and pension contribution arrears also being cleared. This is definitely positive in terms of the equity flows. You know, what we love is a theme whereby the domestic pension fund industry is strong and international sentiment is positive, and the companies are benefiting from a kicker to aggregate demand. Government is usually a large employer in these countries that we look at, so clearing the civil servant salary arrears will result in a positive impact for volumes for the companies in your portfolio. The major themes that we're shaping up the portfolio for in Nigeria are these resumptions in civil servant salaries, higher FAC allocations, fixed capital formation, and the strong oil price, which means that provisions in the banking sector are likely to be reversed, or at least it's a risk area that has been removed from the banks, and an increase in credit demand as the monetary policy starts easing and the central bank allows the economy to be more expansionary. We are particularly excited about, in the banking sector, GTB. It's got high internally compounded rates of return. It's an extremely safe company. Even in periods where the Nigerian economy has been contracting, they've managed to grow deposits and maintain a very high ROE. In the consumer space, we like Nigeria Breweries and Unilever, which is growing double digits in the HPC space. Nigeria Breweries, which is benefiting now from an uptick in brewery volumes. Both very stable companies with positive free cash flows and attractively priced relative to the rest of the portfolio. Moving on to Egypt. Egypt is a country that we've followed very closely for a long time. We've seen consecutive positive PMI announcements. The sentiment has improved, but the main area where we are watching for is for inflation to start dropping. The first positive indicator we were tracking last year was foreign reserve holdings of T-bills. In January 2017, there was about $1.7 billion in treasuries. As of 2 weeks ago, the number was 19.5 billion. The country has benefited from the positive carry trade and the foreign flows into the country. What we're yet to see is a monetary policy that is more expansionary. From what we've been reading and our communication with the management teams and the central bank, they want to see inflation drop a little bit more, which will be positive from a COGS point of view for our consumer-facing businesses as the EGP appreciates and the cost of doing business comes down. The theme we're positioned for there is a lowering of interest rates, which will obviously lift all equity prices. And now as salaries start catching up to inflation, you're likely to see a recovery in volumes. We did highlight some of the other themes in Egypt in the country report. For instance, the Zohr gas field, which goes live in December. This will have a positive impact on the balance of payments and as well as providing domestic gas to the local industry. Moving on to Kenya. The Kenyan election for us was a politically difficult one. Although the turnout in the runoff was low, we were positive that Kenyatta would win the election. The main issue there and the event we're watching for is a modification of the interest rate cap. We don't think Kenyatta will remove it completely. We feel he may allow the cap to be increased by between 2.5% to 4%. He was against the interest rate cap, but he needed to introduce it in order to gather votes as the year went along, and the polls were showing an increasingly close election. We always felt that this was very much a political move in order to get votes. Whilst we think he won't remove it, the opportunities within the country are still very, very exciting, particularly mobile money. Mobile money penetration as a percentage of M3 is about 15%. In the rest of Africa, it's close to 3%. So the growth there is endemic. It doesn't depend on any external forces. It doesn't depend on money supply growth increasing. You're literally getting growth from consumers switching from using cash to using mobile payments. And as the nature of transactions increases, especially on a P2P level, we see tremendous growth prospects as the economy goes to a cashless economy. The themes there, are best, harnessed through Equity Bank and through Safaricom. Equity Bank through its product with Equitel, and Safaricom through M-Pesa. We're particularly excited about Lipa na M-Pesa, which is a P2P payment platform. The one risk area in Kenya we think is continued political noise with Odinga, refusing to accept the current outcome. But we think this presents an investment opportunity into the market because we can pick up companies at decent valuations before they re-rate. Moving on to Zambia. Zambia, the copper rally should turn around the economic fortunes of the country. We expect copper prices to remain stable. The expectation is that output will increase to about 850,000 tons, which is very encouraging for 2018 and into 2019. The central bank has shown that they're willing to loosen the monetary policy as well, which is expansionary and constructive for equities. Overall, we're really, really excited about 2018 going into 2019. Prior to this year, we're defensively positioned in our portfolio. We still remain defensively positioned, but the exciting thing are the tailwinds that are coming from a monetary policy and a fiscal policy point of view. We're also seeing this positive sentiment translate into positive PMI numbers domestically. We think that there may still be risks, especially with the Fed raising rates, which could have a trickle-down effect, but we've tried to shape the portfolio to be decently diversified in good quality corporate champions. Harry, is there anything else to add there?
No, thank you very much, Craig. I think we just open up the call to any questions.
Yes, this is Jack Walker from California. Have you been looking at Angola at all for possibilities?
No, we haven't. We don't have any listed equity investments there, so we haven't been looking at that as an investment destination.
Thank you.
And I think the types of companies that we look at, these sort of corporate champions, strong barriers to entry, high quality management, strong cash flows. We haven't found any of those sorts of companies in Angola.
Oscar here. Have you already spoken a bit about South Africa and developments in South Africa?
Yes, I'll ask Raina to come in there.
Yeah, well, I'm sure a lot of you followed the very interesting events over December. It's a very close call between Ramaphosa and Dlamini Zuma, and what that was really reflected was a very important junction in South Africa. The Zuma presidency over the last 10 years really pushed the country towards crony capitalism and really a loss of belief in investment quality of the country. And the Ramaphosa winning is such a major event for South Africa, because he was really supposed to be the president after Mandela. I think internal politics at that stage at a senior level meant that it had to go more to one of sort of the royal sort of families in the ANC, one of the early families in Mbeki. So Ramaphosa really gives the opportunity for South Africa to kind of right the ship, correct a lot of the problems that happened in the last sort of 5 to 10 years, and it was quite of a slow grind, and only really from 2014 that a lot of the corruption issues come out. So I think a lot of the news flow at the moment is, in terms of Ramaphosa, though he's still only president of the ANC, not of the country, but he's really taking control in terms of corruption investigations. I think what we'll see now is probably, in the next month, we need to see whether Zuma is actually, asked to leave. I think if he does not leave, then the strength you've seen in the rand will probably, I think there might be a bit of weakness in the rand, although I see today it's dropped below the 12 or 11.86 at the moment. I think you could see weakness up to 13 again. If the ANC doesn't move quickly, but if the ANC moves, I think the rand could strengthen quite substantially. And I think that's the big thing at the moment, is the FX. Great companies in SA.
Remind me. Yeah.
It's great companies in
No,
SA.
I'm sorry to interrupt you. Imara, have you got significant exposure to South Africa in the fund at this time?
No, Oscar, this is our Pan-African fund ex-South Africa. So this particular portfolio has no exposure
Right,
to...
yeah. Okay, none at all. Okay.
But we do run a number of bespoke portfolios for clients, and those portfolios do have exposure to Pan-Africa, including South Africa.
Okay, thank you.
Any other questions?
Well, if there are no other questions, I would be grateful, Craig, if you could send me the report on Delta you referred to. I would love to see that.
Okay, sure, Oscar. I was referring to, there was a short blurb on Delta in the November note, but I can send you the investment notes we send each other as a team internally.
I would be very grateful. I would find it of interest. Thank you so much.
No problem.
Thank
Hi, Craig. Sorry, before you jump off,
Sure.
it's Gary from All Seasons.
Hi, Gary.
Guys, I just want to get an idea from you. Morocco, how do you guys see that valuation? How do you see that playing out in your funds? Do you guys will you add exposure to it, or will you keep it sort of the same for the going forward year?
So for now, Gary, I think we'll keep it the same in our other funds. It's a potential opportunity in our Imara Africa Opportunities Fund. I think the thing to be careful of is that we, build our positions carefully, given the volatility in the old mutual implied rate and the issue I mentioned earlier about having a negative price impact on the Zimbabwe portion of the portfolio. So we will be potentially increasing Morocco, specifically in the Imara Africa Opportunities Fund, but in the rest of the portfolios it will remain the same. We see it as a stable economy, but the valuations are a bit stretched. There's also the small risk of a devaluation in the near term. It is an interesting economy in that we found one company, Atijariwafa Bank, which has the combination of kind of the slow, stable growth in Morocco and the higher growth in West Africa and the growth in Egypt from their acquisition. Raina, can you perhaps just give us a couple of points on Atijariwafa?
Yeah, I really like this banking play. It's got the real exciting part of it. It made an acquisition of Barclays Bank Egypt, and it did it at quite a good multiple just before the devaluation of the Egyptian currency. Atijariwafa, before the Barclays acquisition, was a bank's quite a stable ROE, 15-16%. But what Barclays Egypt brings to to the table is an ROE of 32 to 32%, and a very high growth profile of 20% growth per annum, and they think they can achieve that growth for the next 3 to 5 years. The acquisition was a very high quality asset, but it was kind of slightly stable and dormant by the previous management, and they've kind of revitalized that operation. And we've already seen in the last 2-3 quarters quite a bit of quarter-on-quarter growth from that acquisition. Also within their own market in Morocco, we've seen quite a pickup in corporate loan growth. Morocco has gone through 3 to 4 years of austerity. In the last 9 months, we've seen quite a turnaround in that market. After 3-4 years, in that 3-4 years, there was complete deleveraging from the corporate sector, and it's the first time we've seen quite a bit of growth, and that's quite linked to the European recovery that we're seeing globally. So that's quite exciting.
Any other questions, Gary?
If I may, I just want to quickly ask you, January, obviously Nigeria's got off to quite a fast start. Any ideas on sort of what's driving that? And then also maybe just 2 seconds on your thoughts on Tier 1 versus Tier 2 banking.
Sure, I'll let Raina tackle that one.
Sure, let me tackle the banking question. I don't think so the real issue Tier 1 versus Tier 2 is bad debt. A lot of the Tier 2 names have had quite a bit of bad debt in their dollar loans to oil and gas upstream, and the NPL ratios range between 10 and 25% in some of the banks. That's caused very low liquidity and some issues with capital ratios. So what we've seen with the dollar price rising is kind of a relief rally, because a lot of people believe that the underlying loan assets will obviously a lot of the bad debt will recover. We're just a bit worried with those Tier 2 names that some of those assets, even with a higher oil price, a lot of those oil assets aren't actually producing, and they need a bit more capex to actually get them productive. So I'm not sure whether those assets will recover. We're pretty much sticking to the Tier 1 side. We feel that we can get a better performance. So the current outperformance by Tier 2 versus Tier 1, I don't think that will last. So in a way, I'm thinking that the Tier 2 rally that you're seeing right now will be short-lived.
I think, Gary, just overall, in terms of Nigeria, you have seen, 3 consecutive positive PMI readings, and the oil price has run. And, what you tend to see with the domestic PFAs is when domestic yields drop significantly. I think you've seen yields drop 330 to 400 bips. They tend to start weighing up the opportunity cost of investing in T-bills relative to equities. So there's still some very attractively priced companies with decent dividend yields and low PEs. And I think, part of what's driving it is the domestic PFA switching to the equities asset class. Cheers.
Well, if there are no more further questions, thank you all very much for joining our quarterly call. We have actually recorded this call, and we will upload it on a Dropbox and send you a link if you wish to pass it on to any of your colleagues. Otherwise, please contact us directly if you have any further questions.
Helpful. Yeah, that will be very helpful. Thank you. Thank you all.
Thank you all very much.
Bye for now.